Good afternoon, everyone. Thank you for joining today's webinar on novated leasing and salary packaging. My name's Darren Morris. I'm the Managing Director of CXC ANZ, and I'm delighted to introduce today's guest speaker, Alec Kelner, who is from Enlist. Alec is Director of Enlist, a company founded in 2006 and a long-standing partner of CXC. They've actually been working with us since 2007. Alec is an expert in leasing with more than 28 years of experience in the world of salary packaging and novated leasing. Throughout his career, Alex has helped thousands of our contractors and employees, as well as those outside, obviously, the CXC family. And he's been a real thought leader in helping CXC contract community to build some very straightforward and transparent processes that have helped, as I said, thousands of our contractors over many years. So today we're investigating a new subject. Alec will be sharing his insights into the newest tax savings and benefits regarding the purchase and novated leasing of electric and plug-in hybrid vehicles. And yeah, so enough of me. I'd like everyone to please give Alec a warm welcome, and hopefully you'll enjoy the insights that he'll share with us today. So Alec, over to you.
Yep. Thank you very much for the warm introduction, Darren. Welcome, everyone. Thank you very much for joining us today. This presentation should take no more than 30 to 40 minutes. What I'd like to do first and foremost is go through some background and give you an understanding of more information about salary packaging, about how novated leases work, specifically talk to you about the process, what Enlist does, what you can expect from us in this process, what you need to do if you are interested in this. And then I'll talk specifically to some examples, because as far as I'm concerned, everything comes down to the numbers. So it doesn't matter how much I'll tell you that this is a wonderful product. At the end of the day, the numbers need to stack up for someone to enter into this sort of arrangement. So ultimately, what I'd like to do is look at some case study scenarios. For purposes of today's presentation, I've summarized all of the case study scenarios for the slideshows. So all I'm going to ask each and every one of you is to please just trust me on the numbers. But if you are interested and wanted to look into this yourselves further, which we do encourage you, when you call us, we'll be preparing some very specific calculations which have absolutely everything itemized and will be far more clearer than they are in the presentation today. But all I wanted to do today is give you a sort of big picture and an idea what this is all about and how it all works. And then after we go through some case study scenarios, I'll talk to some specific CXC corporate policies and some frequently asked questions. And then if it's okay with everyone, we'll leave the Q&As right to the end. So if you do have any questions throughout the presentation, please feel free, welcome to type them in, and we'll address them at the end of the presentation. Or if you do hold off, you might find that I'll actually cover some of your questions throughout the presentation anyway. Okay, so talking about salary packaging and novated leases. If I can give you just a quick background to how this all started. This goes back to the Keating government back in the late 80s. Prior to the introduction of fringe benefits tax, an employee could have arranged and did arrange with their employers to salary package any type of living expenses, and the employer, as long as the employer agreed to salary package any of those living expenses, they would be able to forego income tax. What I mean by that is that before the introduction of FBT, if you had an employee, let's say, who was on a $100,000 salary, and they went to their employer and said, look, can you pay $30,000 of my school fees? The employer would say, yep, no problem, we'll pay the $30,000 and we'll pay you a salary of $70,000. So as far as the employer is concerned, it didn't really matter. They were still paying $100,000 for cost of employment. But for the ATO, it was a loss of income tax. So to put a stop to this, call it loophole, the ATO introduced fringe benefits tax as a means to stop people avoiding paying income tax or minimizing their tax positions. When they introduced fringe benefits tax, the ATO also recognized that some items, such as cars, need to be concessionally treated in order to promote the industry within Australia. So in that example, where an employer would be salary sacrificing $30,000 for school fees, as soon as fringe benefits tax was introduced, FBT itself is equal to the top marginal tax rate, 47%. So if the employee would continue to salary package $30,000 worth of school fees, they'll be paying roughly $30,000 worth of fringe benefits tax. So the ATO stopped this happening overnight as soon as they introduced FBT. However, for cars, they said that cars are going to be concessionally treated. And the concession comes by way of what we call a 20% statutory rate. So if you have the same $30,000 value vehicle that's being salary packaged and paid for in pre-tax dollars, the FBT is not going to be payable on the full $30,000. It will be paid on 30,000 times 20% statutory rate, which gives us what's called a taxable value. This taxable value is then, in this instance, $6,000, and fringe benefits tax will be roughly about $6,000 rather than $30,000. So all of a sudden, it makes cars very tax effective to salary package. What the ATO has also said is that if an employee pays any vehicle expenses from their after-tax pocket, from after-tax dollars, then this $6,000 taxable value can be reduced dollar for dollar to the point where if the employee, let's say, pays $6,000 worth of vehicle expenses for the year, then the taxable value is zero and there will be no FBT payable. So when we talk to you, and the examples that I've drawn up today, you'll see that I'm using pre-tax and post-tax contributions. And the reason we use that post-tax contribution is purely to offset the FBT liability. And whatever's left over from the total of the finance and running costs, that's where the pre-tax deduction is, where the employees gain the full tax benefit, okay? So when we talk about salary packaging is a term that's coined for an employee to forego a portion of their salary to pay for or to be provided with or benefit items other than in lieu of salary. Okay, when we talk about the term novated lease, it specifically refers to the novate or the salary packaging of a motor vehicle. Okay, the way that a novated lease structure works is a three-way agreement. So when an employee contacts us, we discuss with the employee what their situation is, what sort of car they're looking for, what sort of lease term they like. The lease terms that are available are anywhere between 1 to 5 years, completely your choice, okay? We then work out what the finance payment is based on that vehicle that they are looking at. And if the employee proceeds, we set up that lease agreement with our underwriters, with the lenders, okay? A novated lease itself, it's a two-tier agreement. So there's two separate agreements in the novated lease. There's the lease agreement, which is the finance that sits between the bank and yourself. So it's a financial obligation, just like you're going out and taking out a personal loan. However, with a lease, we're allowed to attach what's called a novation deed or a novation agreement. This novation agreement becomes a three-way agreement between the lender, the lessee, which is the employee, and their employer, whereby all three parties agree to transfer the obligation from the employee across to the employer, being CXC, for the duration of the lease period or their employment period, whichever comes first. And that means CXC agreed to take over the obligation. So let's say if the lease rentals are $1,000 a month, okay, instead of you paying that $1,000 yourself from after-tax salary, by salary packaging it with the novated lease, you'll be able to pay it pre-tax. So you're reducing your income tax expense. And CXC will then withhold that money from your salary, which they remit to Enlist, because Enlist will be managing the whole process. And I'll explain that to you in more detail on the next slide. Okay. But it allows you to pay for the same cost that you would otherwise pay after tax in pre-tax dollars. The reason why CXC is happy to do it is because other than administering it through payroll, it doesn't cost the business anything to do it other than to offer this benefit to the employees. So there's nothing in it for CXC other than providing a benefit to its employees. Okay. So in addition to the finance on the car, when we talk to you, we will also work out a budget for all your vehicle running cost expenses. So depending on the fuel type, whether it's diesel, petrol, if it's electric, and I'll talk a little bit specifically about electric in a couple of slides as well. But based on the type of vehicle, based on how many kilometers you drive, we will allocate a budget that we would expect you to spend for all vehicle running cost expenses, which include your fuel, your services, your tires, your insurance, registration, car washes, roadside membership, if you like. The only items that cannot be included, and that's under the ATO guidelines, are road tolls, infringements, and parking. So those three items cannot be included, but all other vehicle running cost expenses can. Now, we don't know exactly how much you're going to spend on fuel from day to day, let alone over a 3 or a 5 year lease period. So what we do is we take a common sense approach right from the beginning. We prefer to always be conservative and overestimate the budget rather than underestimate, which means that what we allocate, you might be sacrificing a little bit more than you spent, but it doesn't matter because that money ultimately belongs to you. And again, I'll explain to you how we run that in a second. So once we set that budget and you agree to that budget, it's a very simple process. You'll know exactly how much comes out of your salary, whether you get paid weekly, fortnightly, monthly is irrelevant. You'll know exactly how much comes out. You'll know exactly how much money you're left with. And that money that comes out of your salary is remitted to Enlist by CXC each pay cycle. We allocate that deduction to your novated lease account, which we set up at our end. And from that account, we pay all of your actual expenses. When you start your novated lease, you'll receive a welcome email with registration instructions into our portal. Once you get into that portal, you'll be able to see all of the transactions from day to day, all of the monthly account statement reports, and the daily balance. That daily balance literally represents the year-to-date agreed salary sacrifice deductions that are coming out of your wages versus what you're actually spending year-to-date on the vehicle that Enlist is paying on your behalf. So when you finish the novated lease, that balance that's remaining in your novated lease account, that belongs to you. Enlist don't look to make a profit or a loss at the back end. All we're doing is managing the transactions to make it simple for CXC to provide this benefit to the employees. Okay, so when you finish the novated lease for whatever reason, we reconcile that balance. So let's say if there's $500 remaining, that means you've sacrificed $500 more than you've spent. We refund that to CXC and that gets refunded to you via payroll as taxable salary. And it needs to be taxed at the back end. Otherwise, you know, we've had a lot of employees over the years who are, you know, reasonably switched on and will come to us and say, oh, can I salary sacrifice an extra $5,000 or $10,000 each year, which comes out pre-tax, and then you can just refund it to me at the end after tax? Well, no, that can't happen. The ATO will put a stop to that very quickly and they'll say it's a tax fraud. So any remaining surplus is deemed to be excess pre-tax deductions, and that's why they have to be refunded back to you via payroll. And it goes the other way as well. If there's a negative balance, it just means that you've spent more on your vehicle than you've salary sacrificed, that Enlist has paid on your behalf. In those instances where Enlist does carry you by paying more than we've actually received, we do not charge any fees, penalties, or interest. We do manage your balances quite carefully so that we do monitor them. And if we see over a period of time that if you're spending far more or far less, we can always adjust your budgets throughout the lease periods, because at the end of the day, this is your car and your expenses. All that we are doing is managing it for you to make this possible. Okay, so when it comes to the whole structure, ultimately, this is about reducing your income tax and reducing the GST that you would otherwise have to pay on vehicle expenses. And it's about creating more dollars back in your pocket. Okay. As far as the way that we manage the program and the benefits that it provides to you is first and foremost the financial benefits. Secondary, it's the budgeting benefit that from your point of view, you will agree to a fixed salary sacrifice amount each pay cycle. So you will know exactly how much comes out. There's none of these fluctuations that would otherwise happen if you have your own vehicle, and there are periods of, throughout the year where your annual insurance renewal is due and your annual registration renewal is due, and they're usually due around the same time quite often. So you'll have to come up with a big sum of money at that point in time, or when you have to buy tyres or pay for large services. That won't happen. There's a fixed amount that comes out. So from your point of view, it's a very simple outcome and a good benefit from a budgeting perspective. The way that we manage all of your transactions, when we set up the novated lease, we partner with MotorPass. The only reason we partnered with MotorPass is because they're the biggest network in Australia. They tell us there's about 11,000 merchants that are part of the MotorPass network. The cards that we issue are enabled for you to purchase fuels, oils, lubricants, pay for services, car washes, and tyres. The only two expenses that you cannot pay for with the card, or three expenses, are your roadside membership. So if you take NRMA or RACV or ACQ, depending what state you're in, you're welcome to do that. And we'll include a nominal budget for it, and we will reimburse that to you on an annual basis. And the same thing with your registration and insurance. So they are the three items that cannot be paid for with the card: roadside assistance, annual registration renewals, and annual insurance renewals. So with those three items, which are only paid once a year, all you need to do is log into your Enlist online portal once a year, submit an expense reimbursement claim to us. We process and pay these claims within 5 business days of receipt. So we will then pay you the money into your nominated bank account, and you can go and pay your insurer or pay the registration. The only reason we do it that way, to reimburse you rather than paying the third-party supplier directly, i.e. paying your insurer directly, is because it mitigates all possible corporate risk to CXC in the event that, let's say, you've submitted the claim and then you're driving a car, have an accident, and all of a sudden we find out it's uninsured. You'll come to us and say, but I've sent you the payment to pay. We'll say, yeah, but we've never received it. So to avoid those he said, she said situations, ultimately this is your car and your responsibility. So it's on you to make sure that you're paying your annual renewals and claiming a reimbursement from us, and we're paying it back to you, which gets charged against your novated lease account. Okay, hopefully that makes sense. If anyone has any questions at this point, please type them in and we can address them at the end of the presentation. Okay, but from a convenience point of view, for you, it's a great outcome because it means you'll have a card. Any family member can use that card. So it doesn't have a pin on the back. It doesn't have a signature strip. And we do that specifically because it allows all family members to use the cards. We do encourage you not to leave the cards in your vehicles, because it also means, just in case if the car gets stolen, then the thief can use the card as well. But then again, we can then trace where they're going. But in all seriousness, the benefit is great. As far as the cards and the merchants are concerned, they are accepted pretty much at most petrol stations. So whether you use Shell, BP, Caltex, Mobil, Ample, independent stations, most of them accept the cards. Most reputable dealerships accept the cards when servicing the vehicle, and large merchants such as, Bow Repairs, Bob Jane's, Jack's Tires, Kmart Tire and Auto, and so on and so on. Okay, so there's a merchant locator that you'll have access to. So if you wanted to look up various merchants in your area, you'll be able to do that as well. Okay. What it also means under this structure is that there is nothing for you to do. You don't need to keep receipts, and there is no obligation for you to do anything at the end of each tax year. Okay. Now, today we promoted as a discussion about electric vehicles. So I wanted to give you the background to salary packaging and novated leases first and foremost, before I talk about salary packaging for electric vehicles. As some or all of you may already know, late last year, the Australian federal government passed a bill through Parliament whereby they are now providing a full fringe benefits tax exemption for any electric vehicle or plug-in hybrid vehicle. There's a few criteria that needs to be met in order to qualify for the FBT exemption, and it's very simple. The vehicle needs to be under the luxury car tax threshold, which is currently $89,332, and it needs to be a new vehicle or originally new after 1 July last year. So if you're looking for a second-hand vehicle, it basically means you can buy a vehicle up to just over a year old. If it was first delivered in Australia and first registered before 1st July last year, it will not qualify for the exemption. So if you're buying a second-hand electric vehicle or thinking of buying a second-hand electric vehicle, you'll need to do your background check to work out when it was first purchased and registered in Australia. Okay, so as long as those two criteria are met, it will qualify for a full FBT exemption. What that means is that the total cost of the finance and all of the running costs can be deducted from your pre-tax salary, completely exclusive of GST, and we do not need to use these post-tax contributions to offset the taxable value, like I was explaining to you before with your standard petrol or diesel vehicles. So the tax benefit for electric vehicles is significantly greater, and you'll see in these scenarios that we're going to look at now. Okay, now the first case study scenario I want to have a look at, and I've got a few case study scenarios here. Each one I've just used as examples, different salaries and different price vehicles. In first instance, we're looking at someone that wants to compare a novated lease versus a standard car loan, like for like, and they're looking to buy a $30,000 car. If they were to get their own car loan and pay for their own running cost expenses inclusive of GST, it would cost them just under $14,000. Okay. If we look at how that would look to their salary, with the car loan, they would pay income tax on their $100,000 first. They would then pay for the annual running cost expenses out of their pocket after tax. And at the end of the year, they'll be left with $61,000 in their pocket on average over the 4-year period. Okay. With the novated lease, they're paying for the sum of the costs pre-tax and some of the costs post-tax. As I said to you, we're offsetting the FBT with post-tax contribution. So if we have a $30,000 car, and we know that we have to multiply by 20% statutory rate, that means the taxable value in this case is $6,000. So out of this total, approximately $6,000 is taken out after tax, and the remainder $7,000 is the pre-tax deduction, which is reducing the employee's taxable salary. So for purposes of the presentation, I haven't split them out for you, but as I've asked you before, to please just trust me on the figures. Ultimately, what it means is that the employee's taxable salary falls, and the income tax that they pay is just over $22,000 compared to $25,000, which means that they're left with $64,000 at the end of the year versus $61,000. So the real net after-tax cost with a novated lease works out to be $910. The way that we get that $910 is to say that, well, if they were on a straight salary of $100, less their normal income tax of $25,000, they'd normally be left with $75,000. Here they're left with $64,000. So the net cost divided by 12 on a monthly basis is $910. That's what the novated lease will cost you. So ultimately, it means that this employee on a $100,000 salary buying a $30,000 car will save themselves $3,000, or over the 4 years, $12,500 or $12,200 odd. Okay. In the second case study scenario, I wanted to compare someone that, and this is a question we get asked quite often. Do I have to have a residual value, and what is a residual value with a novated lease? A residual value is a lump sum payment at the end of the lease. There must be a residual value in line with ATO guidelines. So the ATO sets a set of guidelines, they're called IT28 guidelines, which stipulate the minimum allowable residual values that banks have to adhere to when setting up a lease. So for a 1-year lease, in very rough numbers, I'll just round them off for you. For a 1-year lease, it's roughly about 65%. So if you have a 1-year lease, that means that of the total amount that we finance, 35% is paid off in lease repayments plus the interest. And then at the end of the 1 year, there's that 65% residual value, right? So a lot of employers will say, well, look, if I was to take a car loan, I don't like having a residual or a balloon at the end. I'd like to pay it all off. So what I'm going to do here is compare someone who wants to look at a novated lease versus them borrowing money against their home mortgage at 5.5%. and paying off the full amount over the same period so they have no balloon. In this instance, what we need to do is not just look at their annual cash position, we need to understand what their overall cash position is after 4 years, taking into consideration the fact that with a mortgage or a loan, they've got nothing to pay at the back end versus the residual with a novated lease. So in this instance, the person who's on $150,000 financing the car privately, they'll be left with $84,000 by paying for the cost themselves after tax, which is the loan repayments and all of the vehicle running cost expenses, inclusive of GST. If they were to finance the car, their finance repayments are obviously less because there's a residual, so they're paying off less equity into the vehicle over the 4-year period. So their annual cash position will be just under $91,000. Just while I'm on this slide, and I probably should have pointed out in the previous slide as well, the main reason why you'll see there's a difference, well, in this case, it's because there's different finance repayments, but there will always be a slight difference between here and there because of the GST. Because with a novated lease, any salary sacrifice deductions that are taken out pre-tax are also exclusive of GST. So there's a double benefit there. Whereas with the private payments, any GST that's incurred on supplies is included. For instance, if you stop at a petrol bowser and fill up for gas or petrol, then you're paying for that inclusive of GST, just like you're paying for your annual insurance and so on and so on. Okay. So in this instance, their annual cash positions are 84 versus just under 91. Okay. If we multiply them out over 4 years, your annual cash positions will be 336.5 versus just under 364. We then take into consideration the back end position. With their private finance, they have no more to pay at the back end. Whereas with a novated lease after 4 years, they've got an $18,500 residual. So once they pay that out, and we look at their overall cash position, even comparing it to a zero balloon and a 5.5% mortgage, which is a pretty low rate, because today's lease rates, depending on what sort of car, what sort of term, but as most of you know, the interest rates have been going through the roof, and where we were, getting money about 18 months ago for about 4%, 12 months ago is probably about 5 to 6%. Now it's between 9 to 10%, and that's taken into consideration here. So it doesn't matter. The interest rate is so much dissolved by the benefit of having the cost paid pre-tax and the GST savings. So overall, this person is going to save themselves, in this instance, almost $9,000 after tax over that 4-year period. Okay. Now, the third example, we're going to look at an electric vehicle. And I'm sorry, I might take you back to the previous slide because I did forget to point something out to you, if you don't mind. My apologies. I'd like you to all to take note and write this figure down. With a novated lease, this was based on a $50,000 car. The novated lease net after-tax cost per month is $1,148. So if you can write this down, on a $50,000 car, it would cost this person out of their pocket after tax $1,148. Okay? Oh, sorry, pardon me. My apologies, I've taken you to the wrong slide. I thought, oh, they were wrong figures. My apologies, everyone. Sorry, the previous slide, and again, I'll just take you to that slide just to show you, to remind you, sorry, that was the $50,000 car that we looked at comparing against the mortgage, okay? And the number that I would like you all to remember, the net cost from their pocket, is just under $1,300 per month. My apologies about all of that. So with a $50,000 car, it was going to cost this individual just under $1,300, $1,292 net after tax per month, okay? With now an electric vehicle, we're going to look at, and I've tried to look at maximum value or close to, a $90,000 electric vehicle. We're going to compare this against the normal car loan first, and then I'd like to compare it against an outright cash purchase. So someone that will say to us, look, I don't need to borrow money, so why on earth would I? Yeah, so I hear that there's tax benefits out of this, even for electric vehicles, but why would I want to do this when I can pay cash and I don't have to pay any interest on my money? So we're going to compare it first on a like for like, loan comparison, then versus cash. So if this person was to take out finance on the car over the same 4-year period, including running costs, it would cost them $26,000. So overall, their cash position would look like $120,000 remaining cash in hand versus $132,000. So, and the reason why the tax benefit is so much greater now is because we're not splitting it between pre and post tax. The entire amount, complete of exclusive of GST, is taken out pre-tax. So the employee is reducing their annual income tax by $26,000. So the amount of overall tax they pay for the year drops from $74,000 just to under $62,000. So their benefit per over the life of the lease is almost $50,000. It's about $12,000 per annum saving. So this $90,000 car is going to cost, as a net cost from their pocket, $1,150, whereas if you recall what the $50,000 car was going to cost, it's going to cost them less than a $50,000 car. In fact, about 2 weeks ago, just if you don't mind, I'll just tell you a quick situation that I ran some calculations for a client. It was about 2 weeks ago. This lady called me up and she said, Alec, I wanted to buy a second-hand used vehicle for my 19-year-old son for about $20,000. She wasn't even sure what sort of make and model. She said, could you run some indicative calculations for me? So we worked out the calculations, and then I asked her, are you aware of these extra benefits that are now available for electric vehicles or plug-in hybrid vehicles? And she said no, so I explained it to her. And then I said, why don't I work the numbers backwards and try to work out how much it would cost you out of your pocket to be exactly the same as this $20,000 car for you to be able to buy an electric vehicle. And we worked out that rather than her buying a $20,000 used petrol vehicle, she could spend $55,000 to buy an electric brand new car, and the out-of-pocket cost will be exactly the same. That's the extra tax benefit that's now possible with these electric vehicles. Okay. Now, with plug-in hybrid vehicles, I must say it was remiss of me to not point out on the previous slide that the same fringe benefits tax exemption applies to plug-in hybrid vehicles, and specifically, it's not hybrids, it's plug-in hybrids, and that FBT exemption will only be available until 1st of April 2025. So if you wanted to buy a plug-in hybrid vehicle, you would need to do it before April 31st of March 2025. And if you enter into an agreement before then, and let's say it's a 4-year lease agreement, the ATO will honor the FBT exemption for that entire period of the agreement. Okay. Now, going back to the case study scenario for this electric vehicle, this is comparing it to a car loan. If we look at this same comparison versus cash, there's no more cost of finance for the individual, so their only running cost expenses for the year are going to be just over $5,000. Okay, having a look at how that's going to look to their take-home pay means that if they were to pay for the $5,000 in running cost expenses, which includes charging costs at 4.2 cents per kilometre, the ATO allows to be claimed through the novated lease, so that's included here as well. It includes registration, insurance, and servicing. Obviously, fuel costs are non-existent with this, which is why the running costs are going to be significantly less for electric vehicles. So in this instance, their annual cash position will be about $140.5. If they're to do the novated lease, as the previous case study, they're left with about $132,000 in their pocket. Over the 4-year period, that will leave them with $562,000 versus $528.5. We now need to take into consideration the initial cash outlay. In addition to that, we also need to take into consideration the foregone interest or earnings that they would have earned. So in this instance, I've assumed that the person, rather than paying cash, could have used that money to offset their mortgage in a mortgage offset account at 5.5% compounding, which over 4 years is another $21,500 worth of interest savings, which they would otherwise earn by not tying up their cash in this scenario. Then with the novated lease, we take into consideration their residual payout at the back end of $34,000. So if you can imagine, in this instance, they've had the $90,000 sitting in their bank account. At the end of the 4 years, that $90,000 has saved them $21,500. Plus, they're going to then use, of that 90, 34,000 to pay off the residual, which would leave them with another 56,000, which is still offsetting their mortgage, whereas here, the money is completely tied up in their car. And their overall cash position, in addition to them having that $56,000 still offsetting their mortgage, they've paid out the residual, their overall cash positions are still going to be overall $44,000 cash after-tax savings at the end of the 4 years by doing this under a novated lease structure. Okay. So I hope all of that makes sense. I know there's been a lot of numbers, and I do apologize with the previous slides going backwards and forwards, but as you can see, this is all about minimizing your tax position. It's not about telling you go and buy a car and make money off it. No, this is about the way that you own a car. It gives you an opportunity to maximize your tax position and reduce the amount of income tax that you pay that you would otherwise be paying to the ATO. You're using that income tax to pay off your vehicle. Okay. Now, finally, I'd like to go through some housekeeping, some corporate policies, and a few frequently asked questions, okay? Firstly, this is only available to pay-as-you-go employees, not to ABN holders. I'm assuming everyone here today are pay-as-you-go employees, but thought I'd point that out anyway. By nature of you being contractors, we came up with a strategy with CXC when we first introduced this program to help contractors continue novating their vehicles and continue to receive a tax benefit even when they take periods of leave without pay. Because if you ever go on holiday or sick leave, you don't get paid. Normally speaking, if you don't get paid, means there's no more salary sacrifice deductions. And that means we have to stop the novation and it becomes unnovated. And if you remember, right at the beginning, I explained to you that there's two parts to a novated lease. There's the lease agreement and the novation deed. If the novation deed is cancelled, it reverts back to the lease. And at that point, if you were to take leave, let's say for a month, that means that for that month, Enlist is not receiving any salary sacrifice deductions and we don't have a balance in your novated lease account, we need to stop the novation and you would need to pay for the lease rentals and running costs out of your own pocket after tax, and you're losing the tax benefit for that period of time. So to help contractors, what we devised was the strategy whereby right from the beginning, it's twofold. Right from the beginning, there's going to be a double deduction. So whatever the deductions that we come to annually, we will, if you're on a weekly pay cycle, it'll be a double deduction for the first 4 weeks. And if you're on fortnightly, for the first 2, monthly for the first month, okay? In addition to that, we also decided to work on a 46-week year rather than a 52-week year. What that means is if you take the annual costs of the finance and running cost budgets that we allocate, rather than dividing them by 52 weeks if you're on a weekly pay, we divide it by 46 weeks. So that means there's a little bit more being sacrificed each week than is generally needed. And that means that if the employee or if you take leave, you've got a surplus balance that's been built up in your novated lease account that can cover you for that period of leave, so we don't have to stop the novation. So whilst you're on holidays or you're on sick leave, we will continue to pay your lease rentals, we'll continue to pay all your running costs, and you don't have to worry about anything, okay? What that also means is that if you don't take any leave throughout the year and you've worked for the full year and received the full 52 weeks worth of deductions, it basically means you've got about 6 weeks worth of extra deductions that are sitting as a surplus in your novated lease account. But as I've said to you earlier, that's your money. You don't lose it. When you finish the novated lease, it gets reconciled and reimbursed to you in full. Okay. Now, as far as some frequently asked questions, we quite often get asked, can I do a novated lease for a car that I already own? The answer in short is yes, you can. It's a very good opportunity to raise money against the car if you can use that money better elsewhere. So if you've got money tied up in the car that you've paid cash, or if you've got a personal loan on it, then you're definitely better off to change that personal loan into a novated lease. So you're converting an after-tax loan into a pre-tax loan. Same way, if you can use that money productively to earn you income or reduce interest where you're not getting any tax relief, such as mortgage on your own property, then that's a good opportunity to raise money against your car. And what we do in that instance is we usually benchmark the current market value of your vehicle. So let's say it's worth $30,000 today. We would pay you the $30,000, and this is what we call a sale and lease back transaction. So we buy the car from you and you lease it back from us, right? So you're essentially leasing the vehicle and paying for it pre-tax, and you're raising money which you can use elsewhere. Okay, so yes, you can do a novated lease on a vehicle that you already own. You can also do a novated lease on a second-hand car vehicle. Banks generally do not have, our banks don't have any issues as long as the vehicle is up to 12 years old by the end of the lease period. So if you wanted to do the longest lease, say 5 years, you can buy a car that's up to 7 years old to start with, okay? You can also buy cars for family members. I think I've got that down the bottom. So if you wanted to do a novated lease, not just for yourself or not for yourself, but for your spouse or for your kids, you're more than welcome to. As far as the ATO is concerned, they don't mind how many. There is no prerequisite on the limitation of how many novated lease benefit, car fringe benefits can be provided to an individual. So if you wanted to salary package a car for yourself and a spouse or for your kids, you're welcome to do that, okay? If you are considering second-hand car vehicles, one thing I'd like you just to be aware of, right? We're not here to tell you where to buy the car or who to buy it from. The hardest part of this whole process is literally you finding the car you want. Everything else is taken care of by Enlist. We will literally, once you find the car, we will literally do everything else. We would have gone through the calculations with you. We'll explain to you how it all works. We'll explain to you how much money you're left with. If you're happy to proceed with that, we will then contact your dealer, arrange the invoice, prepare the lease documents, organize the financial settlement, and all you'll need to do other than finding the car is go pick up the car. Once you've picked up the car, we do everything else as well. We'll communicate with CXC, tell them when they need to start the salary sacrifice deductions and how much they need to start. We will then issue you with the motor pass card. You'll get a welcome email for you to log into the Enlist online portal. It's literally as simple as that, okay? Now, if you're buying a second-hand car vehicle, the one point I do want to also make is that, and this is important to remember, that if you choose to buy the car privately, you're welcome to. Okay, so as I said, it's your car. We're not here to tell you where to buy it from. But one thing you do need to understand, if you're buying a car from a private vendor, it's deemed to be a non-taxable supply, which means there is no GST included in the supply. Whereas if you're buying a car from a dealership, it's a taxable supply, which includes GST. What that means to you is this. When we finance a car, let's say we're looking at that $50,000 vehicle that you're buying from a car dealer. When we calculate your lease repayments, even though it's a $50,000 car and we're paying the dealer $50,000, your lease repayments are calculated on $45,000, or it's about 45 and a half, if 1/11 of 50,000, because the GST is claimed by the banks as an input tax credit, because a lease is a rental agreement. The lease sits on the bank's balance sheets, which means they can claim the GST for the purchase price, and that GST benefit is passed on to you by way of a reduced lease repayment. So if you're buying a car from a dealership, the lease is calculated in this instance on $45,000. If you're buying the same $50,000 car from a private vendor, we're paying them the same $50,000, but your lease repayments are calculated on the full value of $50,000 because there's no GST. So what that means, if you are considering second-hand cars, then you can afford to spend up to 10% more for the same vehicle at a dealership, and it'll cost you exactly the same in lease repayments. Okay, so that's something that's worth remembering. Okay. The other question we get asked is about transferability. One of the greatest benefits of novated leases, other than the convenience of them and the tax savings and the cash savings, is that they are fully transportable between employers. So if you're employing with CXC Finishes and you join another company, most employers in Australia today offer novated lease programs, and it doesn't matter who the back-end provider is. So the fact that if you join a new company, there is no reason why they cannot continue the salary packaging of the novated lease through their payroll where CXC left off. Even if they don't use Enlist, would be welcome to talk to your new employer. It's a great way for us to pick up new relationships, but whoever they use, they'll be able to continue paying that lease rental. It's exactly the same in reverse. So when new employees and contractors start with CXC, we do these on a weekly basis. We bring their existing novated leases into our program. We continue to pay their financier for the remaining term, so they don't have to be refinanced, which will cost people money. We simply continue to pay the monthly lease rentals for the remaining term, and we continue to package all of the running costs which they pay through our program. Okay. And the other options that are available to people at the back end. So if your employment finishes, then you have one of three options available to you. And that is, number one, you can pay out the lease altogether. Whatever amount is outstanding, we simply pay a figure from the bank. Number two, you can continue to pay the lease rentals. You'll be paying for them out of your own pocket after tax. There's no more tax savings there. Or you can renovate the lease to a new employer. So if you are in those situations, and I do understand, having worked with CXC for so many years, the nature of contractors being quite transient between, job roles and contracts and so forth. Usually the best options in those instances are not to pay out the leases, but just to continue them at least for several months and wait to see if you get new contracts, in which case you can renovate the lease back with CXC or with a different employer. Okay, so they're the options that are available to you. So that pretty much concludes what I wanted to discuss today. Hopefully I've made sense as much as possible, and I'll throw it back to the rest of you to see if anyone has any questions.
Great. Thanks so much, Alec, for that informative session. Really compelling around the electric vehicle concessions and tax benefits. We've had a question come through from Armando. So please, guys, please send through any more questions that you may have. It was addressed just at the very end there, just around transferability. But what happens if I leave CXC during the term of the lease? So Armando, Alex did mention that they are fully transferable across to all different employers, which is really great to hear. As well. If there are any questions, please do submit them in the chat now. But while we are waiting for others, I do have another one that's come through from Ming as well, although I'm just having a bit of trouble seeing that. Apologies, Ming, it's disappeared. But also just for everyone to know that we will be sending this recording across to everyone at the end of the session. You can also jump into the CXC portal under the CXC's extras tile and also click on Enlist there and find out some more information. We did have a question pop up as well. Are novated leases applicable to motorcycles?
Yes, I saw that question pop up. Whoever's asked that question, I'm glad you asked the question. Because I'm delighted to tell you the answer is yes, it is with CXC policy. Not all employers allow this, CXC policy does. And with motorcycles, they're even more tax effective than cars, because for a car to be concessionally treated for this FBT calculation, the ATO has a definition of what is a motor vehicle. And quite simply, a motor vehicle is any vehicle which has four wheels, which has up to 9 passengers carrying capacity and up to 1 ton payload. So if you have a motorbike, which doesn't have 4 wheels, or if you have a ute, which is over 1 ton, it automatically precludes these vehicles from using the statutory calculation for FBT because they're not defined to be a motor vehicle. These type of vehicles fall into a different part of the FBT Act. It's called MT 2034. And under this part of the FBT Act, it states that you can use the cents per kilometre FBT method. So if you have, let's say, a $30,000 car, we calculate the FBT or post-tax contributions by multiplying by the 20% statutory rate. So we know there's $6,000 worth of post-tax contributions. If you have a $30,000 motorbike, we don't care what the cost of that bike is. We care how many kilometres that bike travels each year. So we will calculate a determined, so we'll estimate what you think you will ride each year. So let's say, and with motorbikes, we find that people generally ride bikes less than they drive cars. So kilometer usage generally with motorbikes is less, right? So let's say it's 10,000 kilometers per annum. So that same $30,000 motorbike, the way that we would calculate FBT is by saying 10,000 kilometers multiplied by, there's a predetermined cent per kilometer rate. From memory, it has gone up from 1 July. It's either 17 or 18 cents now. So it might have gone up to 18 cents, top of my head, I don't recall. So if it's 18 cents, the FBT taxable value is not $6,000 like it is on the $30,000 car. It'll be $1,800. So the employee only needs to contribute $1,800 post-tax, and the remainder can be completely all pre-tax. So motorbikes are even far more tax effective. Yes, you can.
Awesome. Thank you, Alec, for taking us through that. The question from Ming is, how does the fuel card work for people with EV charging at home?
Yeah, so, well, you can't use the fuel card for electricity, but what the ATO only a couple of months ago, the ATO came up with a paper. They released a paper which stipulates that people with a novated lease are able to claim 4.2 cents per kilometer for domestic charging costs. So what we are going to do, given that this is all new, at the end of each financial year, we're going to, anyone who's got an EV, we're going to send you a prompt, and you can complete a declaration for us stipulating your closing odometer reading, and we'll calculate how many kilometers you've traveled in that year. And based on those kilometers, you'll be able to be reimbursed 4.2 cents per kilometer. So let's say if you've done 10,000 kilometers, that's $420 of your domestic electricity bill. You'll be able to pay pre-tax through the novated lease account. So when we calculate your budgets up front, we ask you how many kilometers do you expect to drive. So if you tell us 10,000 per annum, we're going to allocate charging costs that we would expect to reimburse you of $420, right? And that, my understanding, is in addition to any external paid charging costs. So if you're traveling around Australia and you're using paid charging stations, you can submit receipts and invoices for those, and you'll be reimbursed in full. At this stage, we are waiting for MotorPass. We've been in discussions with them to release cards for those charging stations, but that hasn't happened yet. So at this stage, any of those charging expenses, you can claim an expense reimbursement from us.
Thanks, Alex. We also have another question from Tan. Will the tax savings be less than stage 3 tax cuts next year?
I don't understand. Stage 3 tax cuts? I don't know anyway.
Maybe we can take that one offline and follow up with Tan on that one.
Yes.
How about e-scooters? Can we novate e-scooters as well, Alec?
No.
No. Okay. And then we have a question here from Chai. What is the running and maintenance cost of an EV like compared to a Model 3 Tesla and a Y? Maybe those are more personalized questions that can be addressed through a consultation.
100% correct. So that what I'd encourage all of you to do, if you're interested to understand how this impacts you personally, call us, because our consultants will walk you through the process. We will ask you critical questions based around your personal situation, what sort of car, and we're going to provide you with calculations, not like I've given you today in the slideshows, but very detailed, where you'll see all of the itemization for all of the expenses, right? And with all of those itemizations, we always welcome people's input, because at the end of the day, this is your car and your expenses. All we're doing is managing it, right? So as long as the expenses that we budget for are realistic, right, we're always happy to work with people. We're not like most fleet companies that say, no, bad luck, it's got to be what we allocate and that's it. No, because at the end of the day, we're here to provide you with a service, and we want that service experience for you to be convenient and enjoyable.
Perfect. And just one question we've got here from Stephen. Can you renovate the lease at the end of the lease for the residual value?
Most definitely, yes. Another good question. And that's generally what happens quite often when people keep their car. So when you get to the end of the lease, you generally have one of two options. And that depends on, do I want to keep the car or do I want to get rid of the car? If you wanted to get rid of the car, then you can either sell it or trade it in, and then from the proceeds of sale, you pay at the residual. Hopefully, you'll make a profit. Today, our clients are making record profits. We had one bloke about 3 months ago that I've been doing this 28 years, like Darren pointed out. I've never seen anyone make a profit like this. $60,000 over and above his residual value. It was insane. And any profits at the back end are completely tax-free. If you wanted to keep the car when you get to the end, then you can either pay out the residual and own it privately and pay for it privately, but there's no more tax benefits, or we can refinance it for another 1 year, 2 years, 3 years, and you can continue to enjoy the salary sacrifice benefits.
Great. Thank you, Alec. One question here, is the brand BYD included in the EV list for novated leases?
It certainly is, yes. We've already got quite a few BYDs on the books.
Definitely seeing a lot more of those on the road, that's for sure.
Yeah, and the brands and the models, by every week there's more and more models coming out. MG has a wide range. You know, you've got your Cupras, your BYDs, your Volvo, Mercedes now have entry-level electric and plug-in hybrids, so it's electric and FEVs. Volvo. Tesla is at the moment, from what we're seeing, is by far the most popular, but I think that's because it's the most tested brand that's been around for electric more than any of the others. But we're certainly seeing far more model variations coming through now.
Thanks, Alec. And just one last question from Penny. If you buy a plug-in hybrid before April 25th, can that be renovated after the first lease expires?
Yeah, it can be renovated, but it won't qualify for the FBT exemption when it's renovated. So let's say, good question. Let's say you enter into a 3-year lease just before April 25, right? That lease finishes in 28. You'll receive the FBT exemption for that full 3-year period. If you refinance that residual for another 2-3 years, you can still salary sacrifice it and you'll get some tax benefits, but we will have to apply a taxable value, calculate what the taxable value is on the vehicle, so it will not be exempt anymore when you refinance it. So if you think that's a possibility, my advice is to just do the longest lease period, do 5 years.
Great, thanks for that guidance, Alec. Well, that brings the end of today's webinar. Thank you to Alec for your really great session, and also for everyone for attending. We look forward to speaking to you soon. Thank you.
Thank you, everyone.